Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 9th of November. I'm Daniel Lam, your host for the podcast. One of the essential habits that I've developed over the many years competing in chess tournaments is to analyze games that I have played. And carrying that spirit to my work, I often like to look back to what I wrote or said when I do a new publication and podcasts. To this light, a key assumption that we discussed in the Risk On podcast earlier this week was that US inflation needs to continue to decelerate in order for the recent rally in risky assets to continue. So today, let's dig deeper into this. The key reason why we believe the US CPI is likely to keep decelerating is the downward pressure on apartment rents. Now, the apartment list National Rent Index has been decelerating for 2 years and deflated on a year-on-year basis in October for the fourth straight month. And rent is also likely to come under pressure from supply-side factors too. For example, apartment vacancies are back to their pre-pandemic levels, and the pipeline of new units under construction has topped the previous all-time high for 12 consecutive months. The National Multifamily Housing Council's Market Tightness Survey shows that apartment owners are seeing soft conditions that resembles recessions. Thus, we believe the Fed will increasingly see that they do not need to hike more, as rents push core inflation lower, the labor market indicating signs of softening, and growth generally slows down. Now, you may now ask, would growth likely to slow down dramatically? Well, so far there's no strong evidence on that front. Again, using the chess player's analytical method, and checking the calls that were made on the street at the end of last year, one of the major macro surprises this year must be the strong resilience in the US economy. A huge factor was the solid consumption supported by high level of household cash. Now, for example, the increase in households' aggregate cash holdings peaked at nearly $5 trillion in the first half of 2022 and was still at $4.4 trillion at the end of Q2 2023. Now, a major contributing factor, apart from all the fiscal stimulus during the COVID-19 pandemic, was the net sales of financial assets, which amounted to $2.4 trillion since the end of 2019. So that high level of household cash holdings may hold the key in soothing any slowdown in the US economy. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.